we are not going to have a recession in the US. And of course, that's important not only for the US, but also for the global economy, because when the US sneezes, the rest of the world catches the cold. I would say that if Harris is elected, there'll be more policy continuity. The more uncertainty comes in the case in which Trump is elected. Israel and Hamas are still fighting. There is a risk of escalation to involvement of a war with Iran and with Hezbollah. Even the Cold War between the US and China is getting colder. If the war were to escalate and be a full war between Israel and Iran, then you'll have production and exports of oil from the Gulf blocked for weeks, maybe for months. Could have a shock to oil prices like 1973 Yom Kippur War, like 1979 Iranian Islamic Revolution. And of course, if the relation between US and China were to escalate into risk of even a war on the issue of Taiwan or South China Sea, then of course the market impact would be very, very severe.
Thank you, Dr. Roubini, for talking to ET Online. Let me start by first question. The chances of recession in US look low now. The Fed is most likely to cut rates in another fortnight. How do you see the global market shaping up for the rest of 2024?
Well, I would argue that there's, of course, a separation between what's going to happen to the economies and what's going to happen to the markets, even if the two are related. I do agree that the risk of a recession in the U.S. Is low right now. I think that the baseline will be one of a soft landing rather than a hard landing, a recession. There is still income generation. The Fed is going to start to cut rates now that inflation is lower. The private sector is still dynamic. Of course, there are some soft spots like housing because of high interest rates, but the baseline will be that most likely, unless there is a major global geopolitical shock, we are not going to have a recession in the US. And of course, that's important not only for the US, but also for the global economy, because when the US sneezes, the rest of the world catches the cold, as we saw in the case of the global financial crisis. But there has been a bit of a slowdown, especially in the manufacturing sector. Manufacturing in the US, in Europe, in China is almost in contractory zone, but services are growing quite robustly. U.S. markets have been buoyant. Even the correction that occurred in August has been reversed by the end of the month. But certainly there is an element of frothiness in U.S. stock markets. Part of it is driven, as we know, by the optimism about artificial intelligence changing radically industry, economies, and the world. But there is some element of frothiness. Some correction might occur, but I don't think it's going to be massive, especially if the economy keeps on growing and the Fed starts cutting rates.
Sure, sir. So the U.S. election is coming in November, and what do you think should be the impact? What would be the impact of U.S. election on the markets worldwide?
Mm-hmm. Yes.
What do you think is best for the equity investor, Trump or Harris?
Well, we'll see what is the results of the election. As of now, could be Trump winning, could be Harris. The polls have really tightened since Harris became the candidate of the Democrat. I would say that if Harris is elected, there'll be more policy continuity. The kind of economic policy we've seen, both domestic and foreign, and also the foreign policies of Biden will be pretty much pursued also by a Kamala Harris administration. The more uncertainty comes in the case in which Trump is elected, leaving aside his domestic political views or his foreign political and national security kind of views on economic policy. I would say there are several risks. Risk number one is that he has threatened to impose 10% tariffs on all imports to the United States, even from friends and allies, and up to 60% for imports from China. Protections will cause inflation, will cause less economic growth. He may want also to weaken the value of the dollar as a way of regaining competitiveness. That could lead also to financial volatility and instability. If people expect the dollar to weaken, then you could have a flight from the stock market and the bond market in the U.S. because your returns in dollar will be lower. He's less in favor of central bank independence. He might replace some members of the board, starting even with Powell, and make it less independent. That could cause a rise in inflation expectation. And he wants to make his tax cuts that he passed in 2017, who are expiring next year, permanent. But that's a cost of almost $5 trillion. And if you don't find ways of financing it, you could have a debt dynamic that becomes even more unsustainable. So let's say under Trump, if it has really radical economic policies, you could have higher inflation, lower economic growth, and a significant correction with higher bond yields and lower stock prices. Now, if he chooses wisely economic advisors that are more mainstream, that understand that the impact of those trade policies and risk of trade wars and protectionism and currency depreciation are risky for the stock market, the bond market, and if he realizes that the debt of the U.S. is unsustainable and he has to do fiscal retrenchment, maybe those economic advisors can suggest to him that he should follow a course of action that is more moderate. Otherwise, even in the U.S., market discipline with the bond vigilantes and the stock market also punishing with us a mistaken policy could force actually an adjustment of policies if it goes in the wrong, unorthodox direction.
So let's move to a bit about global situation right now. We have a Ukraine-Russia war going on. We have Israel and Hamas fighting. Then the Suez Canal and the area of the canal is probably under the threat of Houthis. When do you think, how long can the global economy deal with this?
We certainly live in a world of a geopolitical recession, if not depression. As you pointed out, the Russia-Ukraine war is continuing, getting worse. Israel and Hamas are still fighting. There is a risk of escalation to involvement of a war with Iran and with Hezbollah. Even the Cold War between the U.S. and China is getting colder. The interesting thing is that both economies and markets have not been so far that sensitive to this geopolitical risk. My view is that if the conflict between Russia and Ukraine remains contained to the region, then it affects, of course, economies and markets in Russia and Ukraine. It does not have global impact. Now, it did have initially global impact because the war led to a spike in natural gas, oil prices, food, fertilizers, because there was a shock to the supply of all these commodities coming from the beginning of the war. But now channels of exporting agricultural products, even from Ukraine, have reopened. Europe and other countries have been able to buy more natural gas from the Middle East and other parts of the world. Some of the gas and oil of Russia has been diverted to China, to India, and therefore the economic impact on commodity prices has been mild so far. It has not led to a significant global shock. So same thing with Israel and Hamas. If the conflict is only Israel and Hamas, it's terrible for Israel, it's terrible for Gaza and Palestinian, but the impact economically and market-wise is only on some countries in the region. If the war were to escalate and be a full war between Israel and Iran, then you'll have production and exports of oil from the Gulf blocked for weeks, maybe for months. Could have a shock to oil prices like 1973 Yom Kippur War, like 1979 Iranian Islamic Revolution. So far that has not occurred. So I would say that these geopolitical risks are a serious threat, but their economic and market impact has been regional rather than global, because they've been effectively still a regional conflict with limited global implication. Now, the Cold War between U.S. and China is getting colder as long as an economic friction and is gradual, is manageable. If Trump comes to power and imposes 60% tariff on China, I think that the market economic impact could be severe. And of course, if the relation between U.S. and China were to escalate into risk of even a war on the issue of Taiwan or South China Sea, then of course the market impact would be very, very severe. But I would say the market for now are correctly having the view that some of these conflicts are regional and that the relation between U.S. and China are difficult and bumpy, but they're not going to escalate in a full-scale confrontation that will be severe for the economy and the markets and for the world at large. That might be the explanation of why markets have reacted only mildly to these types of geopolitical risk.
Perfect, sir. So one last question. This is about India. Prime Minister Narendra Modi has made this thing of making India a Viksit Bharat, which is a developed economy by 2047. How do you think India can reach that? Is it through manufacturing or through service or a mixture of both?
Potential growth of India is already 6 to 7%. With additional reform can be 8%. And we know what other reforms are needed, whether it's land reform, labor market, more competition, bankruptcy, sort of skilling people, education, even more emphasis on infrastructure, and a wide range of other things. I think those reforms are going to continue. They're going to continue probably slightly slower than they would otherwise, given there is now a coalition government. But it's okay. It's better to have more sustainable things and more democratic process of reform rather than one that is not as democratic. So I think the direction is the right one. I would say that India can get a larger share of global manufacturing, but it's not going to be probably able to, to be having comparative advantage in low value-added, labor-intensive manufacturing. If you do textiles, apparel, or low-end consumer products, there are countries where these things are cheaper, even in Asia, whether it's Bangladesh or Vietnam or other ones. I think that India has had traditional advantages in services and IT services. That's going to remain. But in the future, because of AI, there will be a greater integration between hardware and software. And therefore, that integration implies that given de-risking, given friendshoring, and given that some FDI is going to move out of China, in things that are more high value-added, technology-related, whether it's building iPhones or things that have to do with AI and the hardware involved in it, India, that's a sweet spot. Now, initially, you could argue those are capital-intensive, they're not labor-intensive, and you have a job problem. But I think that the synergy of going into your comparative advantage, that is services and IT services and greater integration within hardware and software, you can attract also significant amount of manufacturing, because in the future, it's not going to be either software or hardware, but the integration between the two. So you should not focus necessarily on low value-added, high labor intensity manufacturing. That's not your comparative advantage. You should focus on higher the value chain, and that's going to create synergies and integrations. It's going to create many other jobs. And by the way, services are becoming global. You can be a computer programmer today, of course, in Bangalore and provide your services all over the world. And if that's one of the skills that Indians have, I think that your market is not your large domestic market, but is a market of 8 billion people where you can provide those kind of technology services. So I would try to stay away from low-end and low value-added, labor-intensive manufacturing, because that's not really where you should be.
Thank you so much, Dr. Roubini, for giving your time. It was a pleasure talking to you.
Great pleasure talking with you.